Over the past month, you've probably seen these headlines scrolling through your feed. Auto insurance rates approved for another increase across multiple states. Insurance companies cite uncontrollable costs. Consumers protest. I didn't change anything, but my premium went up again. Then you open your own bill. You haven't had an accident. You haven't bought a new car. Your credit score hasn't dropped. You've been the same careful driver you've always been. But your annual premium just jumped from $1,200 to $1,450. Today, we're not going to talk about how to save that $250. Instead, we're going to address a far more uncomfortable question. Why are you paying more and more when you haven't done anything wrong? Let me paint you a picture. You're a standard American driver. You commute to work every day, maybe 30 minutes each way. You've had no accidents for the past 3 to 5 years. Your credit score sits comfortably in the middle range. You drive a practical family sedan, nothing fancy, nothing that screams high risk. By every reasonable measure, you're doing everything right. Let's look at what happened to your premiums. In 2021, you were paying around $1,050 a year. Not cheap, but manageable. By 2023, that crept up to $1,250. You noticed, but you figured it was normal inflation, part of everything getting more expensive. Then 2025 hit, and suddenly you're looking at $1,500. Some of you are seeing even higher numbers. That's a 35 to 45% increase in just 4 years. Let that sink in. Your salary probably didn't go up 45%. Your rent certainly didn't become 45% more affordable. But this mandatory expense, this thing you legally cannot avoid, just took a bigger and bigger bite out of your budget. So you do what any reasonable person would do. You call your insurance company. You sit through the hold music, you finally get a representative on the line, and you ask them, "What happened? Did I do something wrong?" And they give you 3 responses that somehow manage to be both technically true and completely unhelpful. This is a market adjustment. Your entire state is seeing increases. Your personal risk profile hasn't changed. That last one is particularly maddening, isn't it? Because it confirms what you already suspected. You didn't mess up. You didn't suddenly become a dangerous driver. The system just decided you owe more now. The most frustrating part isn't even the price increase itself. It's that you have no clear path to improvement. When your credit score drops, you know what to do. Pay bills on time, reduce debt. When you gain weight, you know the solution. Eat better, exercise more. But this? There's no customer service representative who can tell you, do these 3 things and your rate will go back down. Because the truth is, there's nothing you can do. And that should make you deeply uncomfortable. Here's the first idea that's going to sound controversial, but I need you to stay with me. Car insurance pricing has less and less to do with you as an individual driver. I know that sounds wrong. You've been told your whole life that insurance is personal. Good drivers pay less. Bad drivers pay more. The system rewards responsible behavior. That's the social contract, right? Except that's not how it actually works anymore. Let me show you what your premium is really paying for. When an insurance company calculates your rate, they're not primarily looking at you. They're looking at your risk pool. That's everyone who shares certain characteristics with you. Your zip code, your state, your age bracket, the type of car you drive. You're not being judged as an individual. You're being judged as a member of a group. And if that group's costs are rising, your bill rises too, regardless of your personal driving record. Here's what that actually means in practice. Let's say you live in a particular neighborhood. You've never had an accident. But over the past 2 years, there's been a surge in car thefts in your area. Or maybe there's been an increase in uninsured drivers. Or perhaps a series of bad weather events caused a spike in claims. None of this has anything to do with you. But you're in the same risk pool, so you pay. Now let's zoom out further. There are 3 massive cost drivers that have absolutely nothing to do with your driving behavior, but you're footing the bill for all of them. First, vehicle repair costs. The insurance industry's own data shows that the average cost of a single repair claim has increased by 30 to 40% over just 5 years. Why? Modern cars are technological marvels. They have sensors, cameras, advanced safety systems, computerized everything. When you get into even a minor fender bender, you're not just replacing a bumper anymore. You're recalibrating sensors. You're replacing cameras. You're dealing with complex electrical systems. A repair that would have cost $2,000 5 years ago now runs you $3,000, $4,000, sometimes more. You didn't ask for your car to become a computer on wheels, but you're paying for it anyway. Second, medical claim costs. When someone gets injured in an accident, the insurance company pays out for medical treatment. And medical costs in America are, as we all know, spiraling. A minor injury that might have resulted in a $15,000 claim a few years ago can easily hit $25,000 or more today. Physical therapy, emergency room visits, specialist consultations, diagnostic imaging, it all adds up. The healthcare system is broken, and your car insurance premium is one of the many places where that broken system sends the bill. Again, you didn't break the healthcare system, but you're paying to patch it up. Third, extreme weather events. Climate change isn't some distant future problem. It's hitting insurance companies' balance sheets right now. Hurricanes are more intense. Flooding is more frequent. Hailstorms are causing unprecedented damage. Wildfires are destroying vehicles by the thousands. These are large-scale systemic events that affect entire regions. If you live in an area that's been hit by any of these disasters, your risk pool just got more expensive, even if your own car was safely in your garage the entire time. You can't control the weather, but you're paying for it. So here's the controversial statement I need you to understand. You're not paying a good driving fee, you're paying a system-wide failure coverage fee. The insurance you think you bought, the one that rewards your personal responsibility, is increasingly a fiction. What you're actually buying is a share of collective risk that keeps getting more expensive due to forces entirely outside your control. This isn't a conspiracy. It's not some evil plot by insurance companies. It's just the mathematical reality of how risk pooling works when the underlying costs are all moving in one direction, up. And once you understand that, the next question becomes even more troubling. If this has already started, why would it ever stop? Let me show you something that should genuinely worry you. It's not just that rates are going up. It's that they're going up in a way that compounds. Let's do some simple math. Say your premium is $1,000. Year 1, it increases by 20%. You're now at $1,200. Year 2, it goes up another 15%. You're now at $1,380. Year 3, another 10% increase. You're at $1,518. Now, if you are thinking linearly, you might assume that's a 45% total increase, right? 20 plus 15 plus 10. But that's not how it works. Because each year's increase is calculated on the new, higher base. You're not paying 45% more than you started. You're paying over 50% more. The increases compound. This is how you go from a little annoying to genuinely unaffordable, faster than you realize. You're not being hit once. You're being locked into a higher and higher starting point, and each subsequent increase builds on that. Here's where it gets even more frustrating. There's a strange dance happening between state insurance regulators and insurance companies, and you're caught in the middle. Insurance companies want to raise rates to cover their increased costs. That's their business model. Regulators, meanwhile, are terrified of public backlash. They know that dramatic rate increases make headlines and cost politicians votes. So what happens? Regulators often deny the full rate increase the insurance company requests. The company wanted to raise rates by 15%, but the regulator only approves 8%. On paper, this looks like the regulator is protecting you. They pushed back. They held the line. But here's what actually happens. The insurance company knows they need that 15% to remain profitable. So they just come back next year and ask for more, and the year after that, and the year after that. The regulator keeps approving modest increases, thinking they're being responsible. But the end result is the same total increase, just stretched out over time. This is what I call approved chronic inflation. It's not a sudden shock. It's a slow, steady bleed that never quite triggers the alarm bells because each individual increase seems small enough to swallow. But over 5 years, 10 years, you look back and realize you're paying double what you used to, and you can barely remember how it happened. The worst part is that neither side is really lying to you. The insurance companies genuinely are facing higher costs. The regulators genuinely are trying to moderate the increases. But the system they're operating in doesn't have a mechanism to actually stop the upward trajectory. It only has mechanisms to slow it down slightly. So when you ask, when will this end? The uncomfortable answer is, probably never. Not unless something fundamental changes about vehicle costs, medical costs, or climate patterns. And none of those things are trending in a favorable direction. You're not waiting for rates to go back to normal. Normal is gone. You're trying to figure out how to adapt to a new equilibrium that keeps shifting upward. Now let's talk about who really suffers from this. If you're wealthy, this is annoying but manageable. An extra $500, even $1,000 a year in insurance costs. It's not pleasant, but it's not breaking your budget. You adjust, you move on. But if you in that middle band of American earners making somewhere between $50,000 and $90,000 a year, this hits differently. You need to drive. Your job requires it. Public transportation in your area is either non-existent or impractical. You're not wealthy enough to live walking distance from work. You're trapped in a structure where car ownership isn't optional, it's mandatory. Now let's look at your budget. Your rent or mortgage is already eating up 30 to 40% of your income. That's just to keep a roof over your head. Add in car insurance, health insurance, car payments, groceries, utilities. Your fixed costs are already consuming 55, 60, maybe even 65% of your monthly income. When car insurance jumps from $1,200 to $1,500 to $1,800 a year, that's not just an inconvenience. That's a structural crisis. Because you have almost no flexibility left. You cut your rent, you already in the cheapest place you can find that's still safe and close enough to work. You can't cut your health insurance that's either mandatory through your employer or essential for your family. You can't cut groceries beyond a certain point. So where does the money come from? Savings? What savings? The emergency fund you've been trying to build? The retirement account you're already behind on? This is the squeeze. And it's not dramatic enough to make headlines because it's not happening all at once. It's death by 1,000 cuts. Your insurance goes up, your rent goes up. Your utilities go up, your grocery bill goes up. Each one individually seems survivable. But collectively, they pushing you from financially stable to unexpected expense away from serious trouble. And here's the thing that nobody wants to say out loud. This isn't going to get better for you. The system is not designed to give back ground it's already taken. Those fixed costs that now consume 65% of your income, in 2 years, it might be 70%. In 5 years, 75%. You're not struggling because you're irresponsible. You're struggling because the floor keeps rising faster than you can climb. The real tragedy isn't that you can't afford car insurance. It's that you have no room left to absorb the fact that it keeps getting more expensive. I know what some of you are thinking right now. What if I just don't buy it? What if I take the risk? I understand the impulse. When something becomes expensive enough, when it feels like you're just throwing money away every month for a service you never use, the temptation to opt out becomes real. But here's the cold reality, you don't have that option. In almost every state, car insurance is legally mandatory. If you're caught driving without it, you face fines, license suspension, even vehicle impoundment. And if you cause an accident while uninsured, you're personally liable for all damages. That could mean financial ruin. But even beyond the legal requirement, think about the structural trap you're in. You need a car to get to work. Your job is too far away to walk or bike. Public transportation doesn't serve your route, or it would turn a 30-minute commute into a 2-hour ordeal. You didn't choose this structure. This is just how American life is organized. So you can't not have a car. And you can't have a car without insurance. Which means you can't refuse this expense, no matter how much it goes up. When you lose the ability to opt out of something, when a service becomes so structurally necessary that refusal isn't a real option, that service starts to function like a tax. Except taxes theoretically fund public goods and are subject to democratic accountability. This is a private tax, and the only accountability is to shareholders and quarterly earnings reports. I want to be very clear, I'm not suggesting there's some grand conspiracy here. Insurance companies aren't cartoon villains rubbing their hands together and laughing about squeezing consumers. They operate in a system with real costs and real market pressures. But the effect is the same regardless of intent. You're locked into a mandatory expense that keeps increasing, and your only choices are to pay it or face serious legal and financial consequences. This is what structural powerlessness looks like. Not dramatic oppression, but a quiet erosion of choice. Where you keep paying more for something you literally cannot refuse. So let's bring this all together. You haven't had an accident. You're the same careful driver you've always been. But your car insurance keeps going up anyway. And now you know why. Because this was never really about you. The system is transferring costs to you, repair costs, medical costs, climate costs, infrastructure costs, and wrapping them in the language of personal responsibility. Your premium, your coverage, your risk, but it's not your risk, not really. You read just the person holding the bag when the bill comes due for a transportation system that's too car dependent, a healthcare system that's too expensive, a climate that's increasingly unstable, and a regulatory structure that can slow down price increases but can't stop them. Understanding this won't lower your premium. It won't give you back the money you've already paid. But it does something else that matters. It shifts the emotional weight. You might have been sitting with this feeling that you did something wrong, that you're failing somehow because you can't easily absorb these increases, that you should be smarter, more frugal, better at navigating the system. Let that guilt go. This isn't a personal failure, it's a systemic transfer. The system is exporting its costs to you, and it's doing it to millions of others at the same time. Once you see it clearly, you can stop asking, "What did I do wrong?" and start asking, "How do I adapt to a structure that is actively working against my financial stability?" That might mean adjusting your budget to treat car insurance not as a stable expense, but as something that will keep climbing. It might mean making harder choices about where you live and work to minimize your dependence on driving. It might mean pushing for structural changes, better public transportation, insurance reform, healthcare reform, knowing that individual action won't solve this, but collective pressure might. What it definitely means is letting go of the fantasy that rates will return to what they were. They won't. That normal is gone. The question now is how you navigate the new normal. And maybe, just maybe, understanding that we're not alone in this, that millions of people are facing the exact same squeeze can turn individual frustration into collective awareness. Because structural problems don't get solved by individuals feeling guilty. They get solved when enough people see the same pattern clearly enough to demand something different. If you're starting to realize that the problem isn't you, that it's the structure, then you're already one step ahead of where the system wants you to be. The system wants you confused, isolated, and blaming yourself. But you're not confused anymore. You see it now. And that's where real change begins.